Welcome to The Explainer. Today, we're diving into the crypto market, and honestly, it's sending some seriously mixed signals. On one side, you have these classic chart patterns that are just screaming buy. But on the other, the whole foundation of this rally, well, it looks like it could crumble at any moment. So what's the real story here? Let's break it all down.
All right, let's start with a number that really sets the stage for the tension we're seeing right now. $475 million.
That is the staggering amount of leveraged trading positions that were just, poof, wiped out in a single day. Now, this isn't your normal everyday volatility. It's a huge red flag that the market is stretched incredibly thin, and we're about to get into exactly why. So what's making everything so fragile? Well, the answer isn't really about what's being traded, but how it's being traded. You see, this entire run-up has been built on a massive, and I mean massive, mountain of leverage. And to really get what's happening, you have to understand the difference between these two things. First, you've got spot buying. That's simple. You buy actual Bitcoin. The price goes up or down based on real supply and demand. But then, you have derivatives trading. Think of these as just bets on the price, and they're often supercharged with borrowed money to amplify everything. And this chart just lays the problem bare. For every $1 of actual physical Bitcoin being bought, there are $9 in these leveraged bets flying around. So the price we see, it's being dictated almost entirely by this casino of derivatives, not by people actually wanting to own the asset itself.
And that really gets to the heart of the risk, right? What we have is a rally that looks fantastic on the surface, but underneath, it is incredibly brittle. It's basically a house of cards that needs everything to stay perfectly calm. And, calm isn't exactly the first word that comes to mind when you think about crypto.
Okay, so even with that fragile foundation, traders are looking at Bitcoin's chart and getting pretty excited. And that's because a classic textbook bullish signal is taking shape right now. So let's talk about this. It's called a cup and handle. And it's pretty much what it sounds like. The price rallies, then it forms this rounded bottom that looks like a teacup, and then it has a little dip, which forms the handle. For traders, this is a sign that the price is kind of taking a breath, consolidating, and getting ready to launch into its next big move higher. So the whole thing hinges on what happens next. For this pattern to play out, Bitcoin has to break above and stay above that $72,000 mark. If it does that, the technical target is way up around 75 grand. But, and this is a big but, there's a little warning sign. We're seeing something called a bearish divergence, which suggests buying power might be running out of steam. That could turn this whole beautiful setup into a nasty bull trap. Now let's switch over to Ethereum, because it's flashing its own powerful bullish signal. This one is a potential bottoming pattern that could mean a huge trend reversal is on the table.
This pattern is called an inverse head and shoulders. It looks exactly how it sounds. You get a dip, then a deeper dip, then another smaller dip. It's a classic signal that the sellers are finally exhausted and the buyers are starting to step in and take control. It often marks the absolute bottom of a downtrend.
The key level for Ethereum is breaking through what's called the neckline, right around $2,320. If it can do that, this pattern suggests a potential 20% rally all the way up towards $2,730. And we're seeing some real-world support for this theory. The big whale wallets have been buying up a ton of ETH. But just like Bitcoin, the ghost in the machine is leverage. It's climbing, and that creates this risk of a huge squeeze if the price decides to dip first.
Now, this next part is where it gets really interesting. We can actually see where all of this risky leverage is piled up. We can literally map out the market's landmines. We do this using something called Liquidation Heat Maps. And what they do is show us the exact price levels where a ton of these leverage positions are going to get automatically shut down or liquidated. These levels act like magnets for the price because if they get hit, it triggers this waterfall of forced buying or selling.
And for Bitcoin, well, the map is crystal clear. You've got over $1.3 billion in long positions that get vaporized if the price dips below about 66.7. And on the flip side, another $1.3 billion in shorts get liquidated if the price pushes past 73.6. Billions of dollars are just trapped, waiting for a trigger.
Ethereum's map tells the exact same story, just a different minefield. We're talking nearly $1 billion in shorts getting wiped out above 2150, and almost another billion in longs at risk below 1950. The market is wound up like a spring, with just massive amounts of rocket fuel on both sides, waiting for a spark. And with the market wound this tight, all it needs is that spark. And there's a good chance that spark could come on March 18th, when everyone is going to be watching the U.S. Federal Reserve for their big interest rate decision. Now, you'd think that if the Fed does nothing, it would be a non-event, right? But history tells us something very different. Bitcoin's price has actually tanked after 7 of the last 8 Fed meetings. They've become these weird sell-the-news events, where volatility just explodes no matter what they actually decide to do.
Analysts have kind of war-gamed this out into 3 main scenarios. The most likely one, with a 60% probability, is a neutral hold from the Fed, and that would probably trigger that classic sell-the-news dip of a few percent. A surprisingly soft tone could spark a small rally, but if they come out sounding tough on inflation, look out below. That could easily trigger a sharp drop towards 60,000. So yeah, this meeting is the big one.
So this is where we're at. We have these beautiful, bullish chart patterns telling us the market wants to fly higher, but they're clashing with this incredibly fragile market structure that's just drowning in leverage. And to top it all off, a huge macro event is right around the corner.
Let's try to put all the pieces together. Let's weigh the bull case directly against the bear case based on everything we've just looked at.
Okay, the bull case. It's all about those powerful, classic chart patterns on both Bitcoin and Ethereum. And it's not just charts. It's backed up by real, unleveraged demand. ETF inflows are picking back up, we're seeing coins leave exchanges, and the big money Ethereum whales are buying. This looks like the smart money is placing its bets.
But then there's the bear case, and it is just as strong. The market's foundation is shaky, propped up by 9 times more bets than actual buying. That is the perfect recipe for a liquidation cascade, and the Fed meeting is exactly the kind of outside shock that could light the fuse.
And that really brings us to the final, critical point here. The technical charts are screaming bull, but the market's internal plumbing is flashing bright red warning lights. This has created a high-stakes standoff where the next move probably isn't going to be some gentle drift. No, it's likely to be an explosive break one way or the other. The patterns are set, the trigger is cocked, the only question left is, which way does it break?